Greetings, everyone. This is Rich. Just wanted to walk through one of the example templates that we put out on Moodle and we touched on briefly last week. This is the more advanced of the two projection templates. So again, this is establishing a baseline of recurring sustainable earnings and then trying to draw a projection from that. And then how do you go about documenting what your adjustments are and things of that nature. So to begin, my starting point is I just use these real simple set of financials from the teaching note that we walked through last week. And again, this is the teaching note with the 7 steps. We did that worksheet, the 7 steps for each of the 4 or 3 years that we're looking at. So just to bring your, jog your memory. But basically, I thought I'd just take these very simple income statements for 2006 and 2007, and then try to project what I think might happen in 2008. And since this is a hypothetical example, I kind of just played with it a little bit and used my imagination. But I set up this worksheet to kind of concentrate on, okay, here's the historical numbers, unadjusted, so without any tweaks for one-time items. So for example, we have cumulative effect of accounting change here. So that's, I just kept that in there. These numbers here mirror the numbers in the teaching note. All right, so I did just some real basic analysis on this starting point. I said, show me what the gross profit is. Show me what the operating profit is. Show me what the net profit margin is. Show me what the tax rate is. And show me some indication of revenue growth. And I did these very basic metrics because with these, if I know the rate at which revenue is growing, think back to your cost, volume, profit analysis discussion. You know that COGS is a variable that's dependent on sales. So you think if revenue is going to grow 19%, you might expect COGS to grow 19%. So your gross profit would then be stable from year to year, as we see here. So anyway, that's why I do these metrics, because as I get more into this analysis, I want to make sure that these metrics make sense after my adjustments are done. All right, so in the second tab, whereas the first tab is just historical unadjusted, the second tab I said, here's the 2 years I just talked about, and I included some adjustments. So in each one of these cells, I just hard-coded a little tweak. All right, and then using these two to establish my baseline, I said, here's what I think 2008 is going to be. So let's just real briefly walk through what I did. So we had sales that were basically growing at 19% from 2006 to 2007. And what I basically did was I said, give me 2007 and let's project another 19% of revenue growth. And my basic idea is spelled out in this tick mark E. And it's going to be very important for you to do these tick marks, because if I can't follow your work, I'm going to kick it right back to you. So anyway, the sales, so my tick mark basically explains sales should continue to grow at a rate of between 17 and 21% under current business, economic, and competitive conditions. So this is just based on a hypothetical company without much facts. But in your project, you're going to have to figure out, okay, if Kohl's has had 4%, 4%, 5% revenue growth, what about the upcoming fiscal year do you think is going to make it go to 6%? Or do you think it's just going to hold the line? If it's been reasonably consistent, maybe past history is a reasonable predictor of future history. Or perhaps you're reading in the financial reports that, hey, they're doing a whole big online expansion, or they're opening up 20 new stores, in which case you might say, hey, 2000 whatever is the year they grow. So give that some thought as you establish both your baseline and you forecast for the upcoming year. In this case, I just baked my adjustments in the cells themselves, and then I have an adjustments column that kind of isolates things. We'll get to that in a moment. But you'll know also, I would highly encourage everyone to tick mark their adjustments, because when I review your work, I'm going to be thinking to myself, did they catch everything that I caught? Did they catch everything that their classmates caught? And if you make a judgment call, if you say revenue is going to grow 4%, when it's only been growing by 1.5%, you need to have a rationale for that. All right, so the next line, I hypothetically said, you know, I thought there was an adjustment in cost of goods. So let's just, again, this is completely using my imagination, but I basically said in tick mark B, per review of the MD&A section, a non-recurring restructuring expense related to the closure of a factory occurred. This expense was adjusted out of COGS since its restructurings are uncommon and unlikely going forward. So think about the Harley folks. You had restructuring. Do you think they're going to recur or recur in the same magnitude? That's a judgment call that you'll have to make. So anyway, once I've made that adjustment for COGS, you can see that I am basically projecting a steady increase in gross profit. Contrast that to how it looked unadjusted, which was flat. So that's significant. So I call that out and I explain that in a footnote. So at footnote F, which I put on both the percentage change and gross profit, I basically explain COGS should be in decline as the company improves its operational effectiveness and achieves savings through economies of scale and as the business grows. As such, the modest improvement from 06 to 07 should continue in 08. So again, I explain my rationale, I tie it to a business reason because you know I'm going to ask why. So moving right along, operating expenses, I had an adjustment here as well. So I explained that here. A non-recurring loss on the sale of equipment is included within historical operating expenses. Although equipment is occasionally bought and sold by XYZ company, this was an unusually significant transaction. So I decided to back it out. So as a result of that, my operating margins are relatively consistent from period to period. Compare that to operating profit when I haven't adjusted for that, and they bounce around from year to year. So that's the effect that doing these adjustments has. It gives you a blended run rate, if you will, sustainable recurring earnings. Just stripping out all those anomalies that make earnings bounce up and down. So moving right along, I think we all agreed last class that we would keep taxes very simple. So my tax footnote is basically saying as such, taxes were adjusted to reflect the estimated trend in historical taxes at 36%. And that's a reasonable basis for our forecasted tax rate. Again, most companies, think Kohl's, think Harley, think Starbucks, they have tax departments and tax consultants and tax accounting firms that help them manage those rates and try to reduce them to the lowest possible amount. That's beyond the scope of this class, so we're going to keep the income tax rate simple. As long as it's consistent with historical norms, you can use historical norms as a basis for your projection. Lastly, you'll notice that I adjusted out the cumulative effect of accounting change. So this is one of those specific steps in that 7-step process we talked about in class last week. I adjusted that out because that's a one-time event and it's not going to occur again. And then once that is done, again, notice I'm projecting a relatively flat net profit margin, which is consistent, or which demonstrates when you take out those anomalies, the net profit margin is more consistent and sustainable and recurring and consistent with the trend, I guess you could say. So anyway, I think that covers all the bases. And lastly, I chose to format this sheet in a very, what I thought was a simple way, but I isolated all the adjustments on the last page just by calculating the difference. So basically, these notes are the same as the previous page. But this, when I was mocking up this example, this was a reasonable and simple way for me to just isolate. Here's the actual dollar amount of the adjustments. Here's how the financials look adjusted and forecasted. So if you decide to use this sort of format, it has advantages in that you're going to look at more fiscal years than just one. So you have a better baseline expectation to base your projection off of. So that's one advantage. If you expand your analysis to include some important metrics, you'll be able to identify anything that perhaps might not make sense before I ask you about it. So I'd highly encourage you to use metrics. I would highly encourage you to label your worksheet in such a way that it's very easy to see what are historical numbers, what are adjusted numbers, and what are forecasted numbers. So historical, adjusted, and forecasted, or forecasted or projected, those are simultaneous. In any case, make sure it's clear to the reviewer, both me and the audience of your document, because this will serve as an exhibit in your final paper. Also make sure all of your assumptions are notated. So explain, if you strip out a non-recurring adjustment, explain what it is, and explain why it makes sense to pull it out. If you think that revenue is going to grow at Harley by 4%, but it's only grown by 1 or 2% in previous years, you have to explain. Are they going to do that through a combination of price increases? Are they going to do it through a combination of volume increases? Things like that. Anyway, I think these are my last tips. I think this worksheet is somewhat self-explanatory if you take the time to sift through it in conjunction with the teaching notes and the worksheet that we did last class. If you have any questions, shoot me a note. I look forward to seeing you on Saturday. Take care.